What does that mean for the real estate sector as investors look to deploy billions in dry powder that's been on the sidelines? Well, joining me right now, right here on set, is Kathleen McCarthy. She is the global co-head of real estate at Blackstone. And it is great to have you back here. Welcome.
So good to be here. Thanks, Morgan.
So let's start right there, because it has been a fascinating dynamic to see rates, particularly at the longer end, move higher since the Fed began cutting. We know the Trump administration is focused on the 10-year, maybe more so than the federal funds rate. What does it take to bring that down? And if it doesn't come down right away, what does that mean for real estate?
Well, real estate's on a road to recovery. And I think you and I have been talking about this for, it feels like a year now, because really we started to pick up those pillars of recovery coming into place when we started seeing the short end of the curve come down and then additionally spreads coming in. And that's been happening because more capital is coming back to the real estate space. So in 2024, CMBS issuance was 3 times what it was the prior year. We're now seeing really banks get back and much more active as they've seen repayment activity and they want to be participating in this market with their big clients. And I think very importantly also, you've seen a sharp fall off in new supply. So you have this combination of things where our borrowing costs are down nearly 40% year over year because of that combination of spreads and rates. And then additionally, we're seeing in logistics, our highest conviction theme, new supply down 75% or more, housing down 60%. So that really paves the way to cash flow growth. As far as the 10-year, I mean, the way I think about it is like this road to recovery was never promised to be smooth, right? There are going to be some bumps. That's an example of that. But I think you can continue to have great performance in real estate in a higher rate environment, provided that you have cash flow growth. And that's where we're really focused, is making sure we're in the asset classes and positioned to benefit from kind of this change in the supply-demand dynamic.
I want to get into some of the specific sectors you're focused on, but first, just one more macro question for you. We've seen gold on this record run, in part because of maybe fiscal uncertainty, trade and tariffs have been brought up, the possibility of inflation being stickier than expected. Real estate has long been seen as a hedge against macro uncertainty and inflation, too. So does this environment actually create more demand?
Well, we definitely want to be in the asset classes where you have shorter lease terms or leases that really allow you to capture inflation. But I'd say as it relates to inflation, when we look across our portfolio, not just Blackstone Real Estate's $600 billion of assets, but really the entire Blackstone ecosystem where we have 250 companies, what we see is inflation very much coming under control. And we look at the rate of wage growth, we look at job openings, input costs, importantly, kind of increases in rent in our housing portfolio. And it would really actually suggest that kind of the environment is conducive to rates coming down. We anticipate we will be in a higher rate environment. But I think, again, like we see sort of signs that inflation is really in a controlled place.
It's interesting because you and I have had conversations about office. We know it's been pretty hard hit in the last couple of years coming out of the pandemic. There have been reports that Blackstone might be dipping its toe back in a bigger way into some office real estate, perhaps in Manhattan. Is that happening? And if so, what is attractive about it now?
Well, certainly we've seen so many companies coming back to the office. I'd say my commute every day with my girls also would suggest that's happening. But what we're seeing is that for select assets and select submarkets, you're seeing really a strengthening of the market. And probably the best example of that is where I work. We're in the Park Avenue corridor. Blackstone itself extended and expanded its lease. And what you've seen is that vacancy has come down into the mid-single digits in that corridor. And we're starting to have, again, the footing for rent growth. And so what that will start to do is really fill up other parts of the market as well. And so I think we're seeing that tenants in the market in New York City for very large blocks of new high-quality space are starting to have trouble finding kind of the assets they want. But for us, our focus is really, especially in office, where there is obsolescence risk in certain assets, we're going to focus on the highest quality, newest assets we can find. We want those assets where tenants want to be. We want to really just follow that demand. And then, and of course, that's going to be an amenitized building, newer building in a great spot.
Class A, Class AA, those terms I've been hearing.
Exactly.
Retail, you like that right now, too?
Yeah, I mean, we ended the year, I guess, with a bang. We took private a company called ROIC, a $4 billion transaction. And this is following over a decade of real caution around the retail space. But you have to understand what ROIC owns. It's the grocery-anchored shopping center. So one of the things that's proven super resilient is the fact that we all go to our grocery store, we go get an ice cream, we get our nails done, we go to the gym. And what's happened over the last 15 years among all the negativity around retail is that there hasn't been much of that built at all. And so, as I mentioned, tying this through to cash flow growth, buying assets that have proven resilient. These assets are focused in the highest density population centers of the country. They're not making more of that. And so we really feel very well positioned in that particular part of the retail market.
You've made big bets over the last couple of years on data centers and AI-related infrastructure. You were very early to the game, and it's certainly a game that seems to be paying off. Do you feel right-sized with that part of the portfolio, or do you continue to invest there, especially given some of the concerns we've seen that we've peaked in spending and that maybe costs for things like LLMs are coming down?
Well, yeah, we were, I guess you could say, an early adopter. In 2021, we took private a company called QTS and BREIT, and we've grown that company 8 times when you look at its leased footprint. And today, Blackstone has $80 billion of data centers, a pipeline of $120 billion. And I think what we know from all of our kind of insights into the market, our ability to be in direct conversation with the biggest technology users, is that the demand for digital infrastructure, these places and the power to produce computations, it continues with great strength. And DeepSeek is certainly something to really focus on. But I think what it really has done is evidenced how the cost of the compute, the efficiency, was always going to come down over time. And we anticipate that. When we build a data center, it's fully pre-leased for 15 or 20 years to a high credit tenant. We build it in a way that's flexible for the type of technology, the type of computation happening in it. And we just continue to see how all of the tenants we talk to really continue to see demand for their business and therefore demand for the assets that we have.